G'day expats and welcome to another episode of Expat Chat, episode 57 today. And instead of being joined by my colleague and mate James Ridley, who's the Managing Director for the Asia Pacific region, I'm joined by someone better. James's colleague Mitchell Kelsey, who's one of our financial planners who is a specialist on the US side. G'day mate, how are you?
Hey mate, very well, thanks. Thanks for having me on.
No, mate, it's good to have you on here. Good to have you on. It's nice to change it up. I think the audience might be getting a bit tired of James. So just to tell everyone out there, explain, let's say James is going through his third round of COVID right now. So apparently having it once or twice wasn't enough. So he's gone the extra mile. That's the sort of guy that James is. He loves to sort of, be a high achiever. So three rounds of COVID. So mate, sitting on your sick bed, I hope you're feeling better and rest up. So, but as I said, we're joined by someone even better today. Someone actually knows what they're talking about. So Mitch has been with Atlas for how many years now, mate? It's been a while.
Yeah, since late 2018. So I think December 2018 is when I started. And I've been listening to the, Expat Chat episodes for, ever since they started. So it's nice to be able to contribute as well. So.
Yeah, mate, it's good to have you on. And to the folks out there, more so to the clients who are listening, you may or may not know Mitch, but he's actually been involved in your work. So originally Mitch was one of our client service managers. Then he was paraplanner, which meant he was writing all the advice documents. And now he's a financial planner. And so even if you don't know Mitch, there's a good chance if you're a client of Atlas that he would have been helping you in some capacity in the background anyway. So yeah, Mitch is the guy who's been doing all the grunt work for us for many years. The advisors stand at the front and take all the glory for the advice, but Mitch is actually the guy who's been doing all the hard work. So, mate, great to follow your career progression through Atlas, and obviously your speciality is working with clients in the US because God knows that's a technical one, and people need the advice.
Indeed. Yeah, certainly. So naturally, with James and I being here based on the Gold Coast, we sort of look after clients in the Asia Pacific region. So, Asia's, Singapore, Japan, Hong Kong, those sorts of regions. And then naturally, Asia Pacific region also capturing clients in the United States as well. So yeah, have a lot of, discussions and a lot of clients based in the United States as well.
Yeah, definitely. And obviously with a lot of expats heading to the US, it's a busy place for Aussies, busy place for Atlas, providing that service. So before we go any further, just need to do a quick disclaimer. All the information that people had the pleasure of listening and watching today should be construing this as informational or entertainment purposes only. Please don't construe this as personal advice. And if you do have any questions or do need to seek personal advice, please reach out to someone who's licensed like Atlas. So, mate, let's let the listeners, fill them in on what we're talking about today. All things US retirement accounts. So 401ks, Roth IRAs, Back Door IRAs, the whole shebang. Obviously, with so many expats going to the United States, there is that trepidation of do you participate? One, if your employer is offering it, what are the pitfalls? Mate, let's run through some of the key points, and you deal with this stuff on a daily basis. What is, as a new expat going to the US, what's some of the first considerations they need to make when they're looking at, say, a 401k?
Yeah, definitely. So I guess a 401k is effectively the equivalent to superannuation in the United States. So it's kind of naturally a foreign sort of retirement account that, especially for Aussies, heading over there, probably, never heard of a 401k before, or an IRA, which is, I guess an IRA is just the similar to a 401k, but the 401k is just sponsored by your employer over there. And a number of considerations sort of come into it in terms of what you should do with it. Naturally, when you're employed by a company in the United States, they're going to give you the opportunity to contribute to the 401k. And if you're lucky enough as well, you'll also receive some sort of matching scheme as part of your employee sort of remuneration package over there. So sort of opens up some opportunities there to look at, building wealth in the United States, and also, saving some tax in the United States as well. So naturally with a 401k, similar to, I guess, superannuation in Australia, but in the United States, you can look to make contributions, and then those contributions are also tax deductible. So you can also look at, reducing your federal income in the United States. And you're also looking to, put a bit of money aside for retirement as well. So it's a form of forced savings, I guess you could say as well. So
Yeah,
yeah,
no,
those are sort of
exactly.
some.
And certainly that employee matching side is an important part, isn't it?
Mm,
Saving is good, but when your employers get to match your savings, that's, as you say, money for sort of nothing sort of is. Obviously, when you look at the pre-tax component anyway, before you sort of start to pull money out of the 401k, but certainly from a pre-tax component, it's great. If someone's going to match dollar for dollar, then it's a great incentive.
Yeah, it's effectively like an additional salary if you think about it. If they're going to match up to the amount that you're contributing, and yeah, just so long as you keep in mind of the the implications of what you just got to be aware of the considerations in the future. What happens around when you want to look to access those funds in the future and things like that as well. You just want to be aware of like anything, you want to be aware of why you're doing something in the first instance. So yeah, that's important also.
And a lot of the time people work with us because it's not because we can read documents and search on Google. It's more so our experience in work in this area.
Mm.
In your experience of working with a lot of Aussies in the United States, what are some of the pitfalls you've seen with people experiencing in having a 401k?
So I guess, we talked about the first ones. I guess some people, they have that opportunity, they have that, matching scheme provided by their employer, and they maybe don't take full advantage of it. Some employers over there will match up to, 12% of your, match your contributions up to 10%, 15% of your salary over there. So not so much a pitfall, but it's just, I guess, a foregone sort of opportunity there that you could be losing out on. And
Yeah.
then I guess a lot of the pitfalls that sort of uh, are associated with when you come back to Australia and what you look to do with those funds. So if you want to look to access those funds, what does that look like from a tax perspective? Naturally, there's going to be some tax payable to that, depending on where you are. If you're in the United States, you're going to be paying tax to the IRS. If you're in Australia, there's going to be a small component likely payable to the ATO, and just being mindful of that is important, and not taking out the whole balance as soon as you get back to Australia, because that can have some significant sort of tax considerations, both on the US side and the Australian side.
I mean, you touched on a key point there, which I think is important for the listeners to know is, if you don't have a long-term view of your 401k and you do want to access those funds, the question, when we see this all the time on the Facebook groups and other social media channels, do you redeem it when you're in the United States, or do you redeem it when you're in Australia? And 9 times out of 10, people are so busy with the relocation back to Oz that they do it back in Australia. They go, I'll just do it when I get back there. But what they don't realise is that even though there is a double taxation agreement between the two countries, and it does include obviously tax considerations for 401ks, it's not necessarily the same result, is it? So do you want to run through, why that's different between the two?
Yeah, certainly. So effectively, if you're in the United States, you've been there for a couple of years, you're likely, you've met the substantial presence test in the United States, so you're a tax resident there. In most cases, you're not going to be a resident for tax purposes in Australia. So because this is a foreign pension, so to speak, if you're withdrawing from the 401k when you're overseas, that's not going to have any tax implications with the Australian Taxation Office. It's when you're back, and that's when when your Australian tax residency kicks back in. That's when when you're making those sort of transactions, taking money out. That's when you're going to have some implications with the Australian Taxation Office, particularly around if you have there's different types of IRA accounts as well. So you can have your traditional, which is effectively a 401k that you're just running yourself. So just for listeners, I guess IRA just stands for Individual Retirement Account. And then there's two different variations.
That's the sort of the umbrella title.
That's right. Yeah.
These accounts.
Exactly. Yeah. And then you've got your traditional, and then you've got your Roth. So with the Roth, those in particular, those are generally tax-free in the United States when you're looking to make a withdrawal. However, if you're back in Australia, those won't have the same. You won't receive that same sort of tax concession when you're back in Australia, because the Australian Taxation Office is just going to treat it in the exact same manner that they treat a traditional IRA, for example. So particularly around those Roth, most US expats, unless they've been there for a long period of time, 5+ years, that's when they consider different sort of retirement accounts outside the 401k system that they're considering Roth IRAs. But so they might only have, smaller balances, anywhere 50, 150,000. But yeah, definitely if you can, maybe look to access those tax-free in the United States before coming back to Australia, that's a that can save you a lot of tax if you sort of just have that planning in mind before coming back.
Good. It's an interesting system too, where it's a little bit different to Australia, where if you've got your standard employer 401k, your money going in is not taxed, and they don't actually pay the tax until they actually start receiving it on the other end. Whereas in Australia, you pay tax up front. That's that contributions tax. And then that period on, any growth in the portfolio is taxed at that time. So when you do retire and access those funds, it's tax-free. So it's sort of a bit diametrically opposed to how the Australian super scheme works, which can cause confusion because, as we know, a lot of people get on the plane and go overseas and just expect or assume, which is never a good thing to do, that the US system works the same as the Australian super scheme, and they don't look into the details. And, you know, and that's where there's a big tax difference between a 401k and a Roth IRA, because a Roth IRA has tax paid on it, whereas the 401k doesn't have tax paid on it. So you get different outcomes as well. And I think to explain to people the difference between a 401k and an IRA is, Roth IRA is almost like when you go to join a company in Australia, especially in the past, you know, they told you the super fund they're going to contribute to, so they gave it to you. Whereas now Roth IRA is almost like a SMSF that you choose to elect to do it yourself, or you might use a retail fund or another version as well too. So I always find it's helpful to explain, sort of trying to get the apples and apples comparisons between the two, because you know, when people think about that, oh, okay, that makes sense. You know, self-directed versus employee-directed.
Yeah, no, and definitely, you know, the tax, I guess, aspect of it, you know, being, yeah, you're right, exactly. It's pretty much, you know, the opposite to superannuation here in Australia. So here in Australia, the tax on your superannuation, I guess it's a tax paid vehicle. So you pay tax as you go. So the super fund is deducting 15% each year from you when it files it, you know, the super fund's tax returns. You're paying tax each year, whereas with the retirement accounts in the United States, it's just all tax deferred. So, you know, you're not actually paying tax until it comes to a point in time where you look to access the funds. And yeah, I guess the rationale behind that, I guess, in the United States is, you know, you're taking money out when you're older. So you're in retirement, your marginal tax rate is a lot lower. And when you're taking funds out at that time, you know, you're not paying too much tax. So that's sort of the basis around it. Whereas I guess contrasting that to super, generally, you know, after the age of 60, there's no tax payable when you're taking out money from your Australian superannuation fund.
Because it's been taxed basically in its life,
yeah,
and
exactly.
Their preservation age is very similar to ours. You know, obviously Australia, it's 60 for most people. Yeah, and the US is 59 and a half. Is that right?
Yeah, exactly. That's right.
So,
and then if you're looking to access the funds before 59 and a half, just there's a bit of an early penalty tax there, just to, I guess, deter people from, you know, looking to access it.
It's what's that, 10%, is it?
Yeah, 10%, exactly. It just acts to deter people from taking it early, and then just reduces the chances of them relying on, you know, Social Security. I guess that's sort of.
And we should also explain too is that it's 10% on top of the tax rate. It's not a 10% tax of the balance. So you pay is it 30% plus your 10, which, you know, sort of adds up pretty quickly. You know, if you need the balance, you need the balance. But at the end of the day, you know, you're almost losing half your fund. Which negates the benefits of employee contributions and all those sort of things, because although some people could sort of say, well, the employer component's going to cover the tax side of it, so it's just getting my money back. But yeah, there's a lot of arguments behind whether you do or don't. But, you know, the biggest thing for us that I always find, you know, is every person's experience is different. Everyone's motivations and goals are different. You know, some people are happy to leave it to sit there and just keep growing, and they'll draw on it at a later point in time. Other people, they might want to use it when they return back to Australia to buy a house. You know, there's all those sort of different moving parts. So it's always really important to understand the moving parts and what we call the two-dimensional advice between Oz and US, because you could look at on a US site what the penalties are for early redemption and go, okay, great, I'll just do that one back in Australia, and end up paying a lot more tax because the ATO wants a bite of the cherry too.
Yeah, exactly. And you find clients, you know, especially if they have a 5-10 year stint in the United States, they come back. Some of them don't mind just letting that, you know, that 401k that they've accumulated sort of tick over in the background. They don't need to touch it right now. And then you have others that are other clients that, you know, understandably, they just want to consolidate everything back to Australia. They don't really want to go, they don't have intentions of going back to Australia. They want to use those funds, like you said, they want to, you know, buy a house with it or buy investments, things like that. So in those circumstances, they're almost, you know, happy to incur the tax, and yeah, just so they can look to consolidate everything, which you can understand as well.
No, look, exactly. And I think that's the biggest thing out of all this sort of stuff is, you know, there's no right or wrong decision. It's just making informed decisions, and you don't know what you don't know. And that's the reason we do this podcast and enjoy doing it, because people might go, oh, wait a minute, I was going to do that. Now I'm going to do this. But they still may go ahead with the original idea, but at least they know what to expect. It's just not that surprise landing in your lap, go, oh, well, where'd this come from? What the hell happened there? Because that's, I think, the hardest battle with a lot of folks is they have good intentions, but good intentions don't always translate into good results.
No, exactly. Yeah. And a lot of, you know, clients ask me, you know, I've accumulated these, you know, I've got an IRA account, I've got an existing 401k account, Roth, you know, what should I look to do with these? And it really just comes down to your personal circumstance. You know, what do you actually want to do with these funds? And that sort of is a key, you know, fact in determining what you should actually do with those. You know, what you should actually do, whether you want to take it out now or take out a partial amount, and those sort of dictate the sort of, you know, recommendations that we might provide on that.
Yeah, no, definitely, mate. So, look, I think we've sort of gone to enough detail there. You know, there's a whole, like, we could talk for hours on this sort of stuff, and you know, the whole point is just to be forewarned as forearmed, and just let people know how the system works compared to the Australian side. You know, certainly over the next 12 months, you know, I know you and James are looking at running some seminars and webinars on, you know, these complications in more detail. So get folks out there to keep an eye on our website at atlaswealth.com. Mate, we've got a question here that came in from Lynn, and you know, I'm glad to have you on here, so I'm going to throw you under the bus here.
Cool.
As part of that, just to the folks out there, we do a Q&A section as well. So if you do have any questions or feedback you'd like to send to us, there's a link in the show notes below. So Lynn says, if you're a self-funding retiree living overseas after working and have a house, etc., in Australia, as you want to live there in a couple of years' time, I'm assuming she wants to move back in a couple of years' time. Meantime, with the new residency rules that may start, how is that going to affect us as an expat, especially if you have to go to Oz for family commitments? So this is an interesting one, because it's sort of hypothesizing based on the new residency rules that haven't come out yet. So
don't know a lot about
Yeah. So do you want to talk about in the current tax rules, not the new proposed ones, you know, how that would work in that sort of scenario?
Yeah, sure. So it sounds like Lynn's sort of looking to retain her non-resident tax status. So doesn't want to be treated as a resident, because as a resident for tax purposes, you know, subject to tax on your worldwide income. So for, you know, existing tax residency tests, you got the resides test. So, you know, as part of the resides test, it's basically just, if you meet the resides test, you'll be treated as a resident for tax purposes. And in determining whether or not someone meets the resides test, it's basically just looking at a number of different factors. So one of those factors is, I guess, accommodation in Australia, economic ties. It could even fall under that. But, you know, having that one factor in isolation isn't necessarily going to result in you being treated as a resident for tax purposes, so long as, you know, most of the things that you're doing are sort of overseas centric. You know, you're not sort of sending money regularly back to, you know, accumulating cash in an Australian bank account. You're not sort of making regular trips back to Australia. So long as your, you know, day-to-day activities are that of a overseas, you know, non-resident, then that, you know, in isolation is unlikely. I won't sort of give any sort of tax advice, but that in isolation isn't necessarily going to result in you being treated as a resident for tax purposes.
Yeah, and I think actually an important addendum to that too is, and you know, I've handled quite a few clients recently who were looking at doing this. You can go overseas and still be considered a tax resident of Australia with no penalties. The key consideration is your structure. So in Lynn's case here, she's a self-funded retiree living overseas. Now, this is excluding she doesn't say what country she's in, so let's put that on the side for a second. If she is fully self-funded through a super fund in allocated pension mode, therefore all income coming out of Oz is tax-free anyway, whether she's resident or non-resident. So sometimes people tie themselves up in knots to make themselves a non-resident, when in actual fact, you know, if she retains residency, then she still access the 50% capital gains discount on any property, all those sort of things. So, you know,
tax-free threshold. Yeah, exactly.
I think when you go from accumulation phase to pension phase, sometimes the importance of maintaining non-residency isn't as important as it is to be a resident. In my case, I'm earning income living in Dubai, so obviously you've got a vested interest in becoming a non-resident. Whereas with Lynn, if she's not paying tax to the ATO, then whether she's resident or non-resident, she actually might preclude herself some other benefits as well too. And
No, exactly.
if she's fully self-funded through a super fund, then the good thing about that is she can come back and forth as often as she wants. So concerns about housing, she can move back and forth. Now the big question is what country is she in? So you can be a resident of two countries, tax resident of two countries. Depending on this, there's a DTA, the tiebreaker clauses and all those sort of things. So I guess to answer Lynn's question, sort of, if you are a self-funded retiree and it's fully funded through super, don't be too concerned about resident, non-resident, because sometimes being a resident is actually the better option, and it's actually a good option to say, Lynn, you need to reach out and get advice for this because everyone's circumstances are different. If she's holding an SMSF, that might be a different story, because of the temporary absence rule for 2 years, depending how long she said she's going for a couple of years, so it might be inside that 2-year period. So, I think it's one of those Pandora's boxes. You and I could sort of pick that up for the next hour.
A lot of considerations there, a lot of questions, additional questions for sure.
And I think also too, that's the biggest thing as well is, it's what suits them. Sometimes, even though you might pay a bit more tax by being a resident, you get a lot more benefits by being a resident as well. So it comes back to that person. Some people want that Excel spreadsheet, black and white, I want to be zero tax, for whatever reason, which is great. But then they forego all these other things and they're okay with that. But other people want their foot in both camps, which is sort of what I think Lynn's referring to, being able to return to Australia at different periods of time for family commitments. So, it's not always about the financial reasons why you set something up. It has to be that personal side too.
Yeah, you want that flexibility for yourself as well. So,
nothing worse than making a rod for your own back in terms of, doing that. So thanks very much, Lynn, for sending that in. Mate, I think we'll wrap it up there. Just a bit of housekeeping for folks out there. In the show notes below, obviously that Q&A section, please, if you've got any questions, burning questions, you've heard at a brunch or a barbecue or at a bar, feel free to send them in. We're always happy to confirm or squash them, whichever way they are. Also, too, a bit of a shout out to, we actually run 2 podcast channels. So one's the Expat Chat, which is the one you're on right now. Then we have the Expat Mortgage podcast, which is run by Jeremy, who's the managing director of Atlas Mortgages. He does all of our clients' mortgages for expats around the world. So if you do have an interest, obviously, in the mortgage space, you are looking to either buy a property back in Australia and want to learn how to do it, or if you have a property back in Australia and want to talk about refinancing, or, they're going through some pretty good topics right now about these New South Wales stamp duty law changes, the Queensland, land tax changes, which is huge. There's a lot of those sort of things going in the background. So I'll put the link below to the Expat Mortgage podcast so people can run across and have a look. Like with the Expat Chat, we try and keep them short and sharp. So whether you're walking the dog on the treadmill in the gym or driving on the way to work, you can get that nice condensed, factual information that helps you guys make the best. So I'll leave it there, mate. So thanks very much for having me on the show, and we'll
thanks for having me.
Definitely get you back on, because there's a lot more topics we can talk about. How was Australian super treated by the IRS? What is the Heart Tax Act? There's a lot of those things. So, mate, don't be a stranger. Let's get you back on, and
Happy to.
We'll see you soon.
Sounds good, mate.
Thanks, mate.
See you later.
Take care. See you.
Bye.